How much traction do you need to attract pre-seed or seed investment? In this video, we're going to explore that very question because a lot of founders get confused, and rightfully so, because unfortunately, there isn't an exact formula that you can use. Every investor is going to be a little bit different, but there are ways that we can piece together the story so you can get a good idea on what to expect in the marketplace should you go out and try to raise funding at different levels of traction. My name is Ed Kang. If we met before, welcome back. As usual, use the chapter markers to skip to the good part of the video. If we haven't met before, I'm a 7-time funded founder with 2 exits, and that's just a fancy way of saying I failed a bunch of times to your benefit because I use YouTube videos like this and my channel to try and help early stage founders, especially if you're raising early stage funding, avoid some of the catastrophic mistakes that I've made in my day. Not to say you're not going to make mistakes, but I'm going to try to make your life a little bit easier for you. I myself have raised over $100 million for my startups, other people's startups, as well as startup funds. I'm also the Chief Strategy Officer for Startups.com, where we're helping hundreds of founders raise early stage capital. If you haven't heard about us yet, go check us out. If you're already a member of Startups.com, thank you so much. We appreciate your support. While you're here, do the YouTube thing, like, comment, subscribe. Your feedback is always helpful. Let's jump into how much traction that you need to raise pre-seed or seed funding. As I said, this isn't an exact science, but we can follow the breadcrumbs and the clues left by other investors to start to put together a picture on what you can expect and what standards you should be shooting for as far as traction if you're raising funding. I found this data from Right Side Capital Management, and they surveyed 110 seed and pre-seed VCs for their revenue expectations. So these are venture capitalists, and you have to understand and remember, VC works different than your angel or your FFA investor. This is la creme de la creme. We're talking about Sequoia, A16Z, Y Combinator levels of investors. But again, it's great to look at what their standard is as far as revenue. And we're going to get to other forms of traction in just a moment, but stick with me and let's explore this data. If you're trying to raise a $4 million seed, so you've got pre-seed already done, you've got enough traction where you're trying to raise $4 million. And remember, it's VC. You're raising seed so you can go to A, B, C, and then eventually a glorious exit in some form or another. 17% of these VCs are willing to invest in you in pre-revenue states. One more time, lack of revenue doesn't mean that you've got no traction whatsoever. I'm going to say at a $4 million seed, even though you might be pre-revenue, you have significant traction and you've proven it. Next is 29% want 150K to 500K, and that's actually not bad. And you're going to see that these standards have changed since 2021. I'm recording this in 2025, but 2021 was the heyday where these standards were lower. Now the goalposts have moved because of the market meltdown. Capital is no longer cheaper. We've got a few things happening. Oh, you might have heard of them, like Donald Trump, tariffs, the market's melting down, etc. Things are definitely a lot tighter, but the goalposts, even though they've moved, we're still seeing that 17% will invest pre-revenue, 29% you want to be targeting 150K to 500K. And then equally close to, at 28%, 500K to $1 million. And I would say that that's going to be the general range around $1 million that you're going to see the vast majority of seed companies start to experience easier success when it comes to fundraising. $1 million is just that psychological level that we've seen in the past move the needle for seed funding. And then rounding out at 24%, 1 million plus. So you're really looking at the majority, like 50% of companies need to be in that 1 million range, and that's if you're seed. Most of my audience, those of you out there, you're not at seed level, but I think what you want to do is look at those standards and get prepared. That's what you need to be shooting for. If you raise pre-seed from VCs, they're expecting you to go to that seed round. Let's take a look. 1.5 million pre-seed. And let me just state by saying that it is much easier to raise a 1 million and lower pre-seed round, but the average pre-seed round for hyper-growth startups that everyone's betting are going to go unicorn in the past has been about $1.4 to $1.5 million. But the frequency of checks and the checks that have stayed consistent through this market meltdown, through this nuclear funding winter, I've seen checks or funds raised of 1 million and under stay consistent and steady, where those 1.5 million rounds or those 2 million rounds have significantly declined in the past little while. Now, here's what's going to blow your mind. Well, at least it blew my mind last time I looked at it, and that is 46% are willing to invest pre-seed at pre-revenue. That dumbfounded me because back in the day, all pre-seed was pre-revenue. Pre-seed was pretty much, listen, we've got an idea and we need to build it. we have an MVP or proof of concept. We know how to build it, and we built something. Now we need pre-seed. There was no conversations about revenue, but we're seeing that 46% still will invest pre-revenue, and that has major implications. 27% need up to $150K. So that's $12,000 to $13,000 MRR. That's what you want to be shooting for. Monthly growth is extremely important depending on what type of startup and what industry vertical that you're in. But once again, I was a little staggered by this when I initially saw it, but reality started to sink in that now we're starting to see that goalpost move, those standards get raised up, that you need to be generating revenue. So if you can get to that $10,000 MRR, then you're going to be doing good because you open up your options. You add 27% of these investors. Now, 15% need to see 150K to 500K. Take a look. 500K, if you look, that's actually a seed round. And that's where this entire market is getting wonky. Am I pre-seed or am I seed? And founders get confused. And I like to say you're in this weird purgatory zone of founders who are in that 500K to 1 million revenue. Are you really a seed company? Well, maybe it would be better to raise a pre-seed and get investors in at a better valuation for them, and then under promise and over deliver, and then raise a better seed round, a bigger seed round at a better valuation. The problem that we have is if you raise a pre-seed at a significantly higher valuation, the risk to you of going into a down round at seed and investors looking in the other direction or giving you a much harder time significantly increases. And that's where this starts to get a little confusing, a little worrisome, whereas it was simple before. Pre-seed, we didn't have any revenue. We're just figuring things out. Give us some money to figure things out. But now the lines are getting blurred and we're starting to see crossover. And that's the reason you have to be really smart and really wise and start to think strategically about how you're going to be raising your pre-seed round. Now, to make it even more complicated, 10% want 500K to $1 million in revenue. At which point I say, if I'm a pre-seed company and I'm making $500,000 to $1 million, then why do I need you as an investor? The answer to that, of course, is it's complicated. There's so many factors, headwinds that are pushing against startups these days from scaling past that $1 million mark, such as fractured distribution models. It's not as easy to get marketing, customer acquisition out there because consumer behaviors have changed. There's so much more competition. Anybody can develop a product and put it in the market, and that's a distinction that you have to understand. But before you get totally discouraged, remember, revenue is not the only traction, but you have to be de-risking the investment. Traction is anything that de-risks the investment for the investors. Always have the word traction in your mind. That is so important. That is the one word that is going to be the great equalizer across all startups. So never forget traction. You should be thinking about traction from day one. I see way too many founders go out there and say, we've been building our product for the past 6-9 months, and we're about to launch in 3 months. How do I go get customers? That is not the way that you can afford to be thinking. Maybe back in 2021, or maybe back all the way in the early 2000s, then you can start thinking, well, we're going to get investment money to get traction, such as the freemium model. We'll worry about monetizing it later. That doesn't work anymore. You have to be thinking traction. Just to be a broken record, say it with me, traction, traction, traction. So what do you need to be taking away from this and start acting upon as soon as you finish this video? First, let's look at the general takeaways, the general advice that I have for you. And that is, if you can attract VC, then angels and FFA become easier. Don't get in the mindset where you say, well, okay, thanks, Ed. VCs need this, need that level of traction or revenue, but angels and FFA investors don't. So I'm just going to lower the standard and go after that type of money. And I understand that type of thinking, and you might have to go down that route. But why? If you can set the standard and say, hey, if I can attract VC and I have to wade through all that competition, well, angels and FFA are just going to become that much easier. You might not be able to get into VC because maybe your industry is not hyper growth enough. There's not enough big TAM. But if you're making that level of revenue, other investors will be interested. And that's the mindset you should be taking. Act like this is the new normal. Don't go out there and say, well, Ed, I know eventually interest rates are going to get dropped, the market is going to get frothy again, and I'll be able to raise based upon a pitch deck or my reputation. Only 1% of founders out there can actually raise based upon their pedigree, reputation. It's not as easy as many people make it out to be. And if you think you can go back to the glory days where you can raise based upon a sketch on a napkin or a really nice pitch, it's not going to happen. This is the new normal. Because what is going to happen is that investors are going to start making money based upon this new normal, and the bar will be permanently set there because all the standards of founders and the pedigree startups that are showing that this works will create this new kind of level and it's going to push everybody up to new levels of excellence, or those expectations are going to be standardized. Now, as always, if the market gets frothy, you are going to see investors loosen up just a little bit, but don't expect that. Act like it's never going to happen, and if it does happen, well, you're just going to be better positioned, and that's the best spot for you to be in. Now, if you're pre-revenue, these are the things you should be thinking about. One, your chances went down by half. And I'm saying this not for doom and gloom to deter you, but to manage your expectations. Founders look at me dumbfounded or very disappointed, or they get angry at me, and I just explain to them, listen, you have to understand market dynamics. There's liquidity, there's IPO issues. So much money was wiped out of existence because of the meltdown starting in 2023. You don't want to be caught with wonky expectations and be severely disappointed, because that's going to emotionally leak into the rest of your startup, and you're going to have a harder time fundraising. On top of which, if you're pre-revenue, you're going for those 47% of investors that will invest without revenue. You're just going to have more competition, because it's easier to start a startup and everybody's going to go and try and get those same investors who are willing and open. Therefore, those investors are going to have way more choice, and they're going to be choosier. My final point here is revenue may not be the only type of traction, but it is the standard. So go out and make money. Founders that come to me and say, what are the other forms of traction? Can I get a waiting list? Can I get people to sign up, prepay for things? Fantastic. But the closer you get to money being exchanged, the better off you will be. So think in your mind, go make money. I had a chairman one day for one of my startups, and he would always say, Ed, if you're ever confused, whenever you're in doubt, go make money. And that lesson stuck with me, because I said, you know what's going to really tell me the feedback in the market? As soon as I tell users the price. I heard that from Y Combinator one time, and that really embedded itself in my mindset. I started trying to sell from day one. I also talk to investors from day one, whether I need them or not, because I want to make sure that my ideas are validated in the market and in the minds of investors, and I figure out all the pieces on what these investors, what customers need to see for it to come together for me to create the ideal conditions for my funding. And truth be told, I can bootstrap, I can seed strap at worst. At best, I don't have to ever rely on investors again, and that's the optionality that I want to be in. That's the power position, those power dynamics where they need me more than I need them in terms of investors. That's what happens when you go out and generate revenue. So if you're trying to play games and say, what are all the other forms of traction to attract the investors? Start to think, okay, what are the basics? How can I go out and make revenue, make money? And if I get other forms of traction, other forms of validation along the way, that's just going to be icing on the cake. I'm going to tell it all to investors. But all investors are going to think that revenue is just the best form of traction. It attracts them, starts the conversation, makes sense for everybody involved. We're good. Take that approach. Watch some of the other videos that I put on the screen. I hope this has been helpful. Let me know what you think. Let's have a conversation. Do it together. All right, you're not alone out there. Thanks for hanging out with me in this video. I'll see you in the next one.